welcome to today's episode of GorillaCast. In the studio today, I have Juha Lindfors, partner of Lifeline Ventures, and I'm happy to call you a friend as well. Welcome to the show, Juha.
Thank you for having me, Ami.
All right. In today's episode, I think it would be good for us to set the scene a little bit to potential founders to understand a little bit better the venture capital scene here in Finland, and I think in general a little bit more as well. So if we'll just start with a quick introduction. So Juha, could you tell us a little bit about yourself and Lifeline Ventures as a fund?
Sure. I can start with Lifeline shortly.
Yep.
Early stage Helsinki-based fund, currently investing from our Fund 5, been around since 2009. Company started by my colleagues Timo and Petteri, and we are, I would say, the earliest money in. Quite often we are the first investor in the companies. It doesn't mean that we have to, but quite often that's the case. Generalist, meaning that we have a very diverse portfolio, if you would look at it. Quite active investor in terms of number of investments, but also how we want to work with our companies. And maybe worth highlighting that although we are the first money in, I think we would like to be the last money out, meaning that we're not really seeking any interim type of exits. And we all know, and you particularly know it very well, these are long-term commitments. So funds we have are pretty long, and on the other hand, investment periods are pretty long. And maybe short background, the way I ended up at Lifeline, we started to I would say, through angel investments together with Timo and Petteri, and that must be like 2010, first angel investments, and then I joined as partner in 2016. And my own background is in investments, been moving from like leverage buyouts towards this, you could say, the earlier stage of investing. So soon, I believe, 25 years always in private companies, always with companies seeking, growth and constantly improving what they do, but very different compared to like what I started with and versus what we do now at Lifeline.
All right, thank you very much for the introduction, Juha. And on your description, our paths crossed for the first time in 2012 when I was raising funding for a company called Optomeditech.
Yeah.
And from 2012, when Lifeline and you invested in the company, I've then been working with your portfolio companies for the past 12 years before I jumped into Gorilla Capital this February. So I think I have a pretty good insight into what Lifeline does, and it's been a fun journey together.
Yeah, it's true.
So you said that you're investing now from Fund 5.
Yep.
And if we look at the track record of Lifeline, it's been nothing short of amazing. But if we think about this kind of venture capital structure in general, I think it would be worth giving a little bit of background to our listeners as well. So when you're putting together your funds, I think the structure is that the partners who are involved put in some of the money themselves, but then a lot of the money into the fund comes from external investors who are then limited partners, and they are essentially investing into you as a team and your investment strategy and what it is that you're promising to do to them. So could you talk a little bit about the investment strategy that you have in Lifeline Ventures? You touched upon some of the things already, but if we dive just a little bit deeper. Yeah.
Sure. Maybe to start with is that I would say, although I was not around when the firm was started, but if we look at the first 15 years now, it's been the same strategy that, as I mentioned, we are in most cases the first investor, or at least after the so-called family and friends type of investment. So that's still the case, that we want to engage early. So I guess in VC language, that's like angel, pre-seed, but seed, you could say, in general stage. And then there will be follow-on investments, of course, but for us, it's always the early stage. Quite often, there's not that much in the beginning. If you look at that, what you can analyze, and if you want to conduct so-called due diligence, so there's not that much. So you focus on the team, and it's basically an evaluation that is like, I mean, everyone says like world-class team, but that's really what you're after, that are they able to build something they say they want to build. And I think for us, it's like, well, 80%, 90% of that like evaluation is really the team. And I would say technical competencies, but on the other hand, also the kind of commercial side, but more, I would say, in the beginning from the perspective that have they really identified the, like, let's call it the crucial customer need. It doesn't really, I don't think, get more complicated than that it's the team. And then there's, of course, the market. But in the beginning, I would say it's more like, of course, you want to be in so-called, say, good markets. And we all probably can name characteristics of like good versus like less good or bad markets. But it's more for us, I would say, market in that sense that, you know, can you build a substantial business in that space? And then we already, of course, discuss that there needs to be the customer need or the problem you're solving. But for us, it's mainly, I think, the process also, that how did the team came up with the idea? How did they validate it? And then more the process, I would say. And then, of course, there needs to be some hypothesis, I would say, in the beginning, that how do you acquire customers? So you could say team, whatever way you put, but the most important thing, market, product, but more like really you could say identified need, and then some kind of customer acquisition process or hypothesis on that. That's what we look. And then you say that, okay, how do we like bring all these together? It's that we always have this discussion that can you somehow imagine an outcome in the future, can be very far away in the future, that this one investment, if everything goes well, and probability can still be super small, can it kind of return the whole fund? That's, I guess, why you hear VCs so much talking about these fund returners, that every single investment really, in the beginning, before you invest, you should be convinced that you have that kind of potential. That was a long answer. But.
No, but a lot of critical and good information in there, and let me kind of pick up on, as you said in the end, that one of the criteria that you're looking at is this investment potentially a fund returner, and even though you are deploying the same strategy you have been using from the beginning of Lifeline Ventures, your funds have been steadily growing.
Yeah.
So what fund returner means to you in Fund 5 is very different
it's
from
different
what it meant in first and second. So
exactly.
So I would assume that then means that the opportunities that you're looking at today, you need to see even more upside than you would have seen in the early investments you made from the first funds.
That's true. And that comes, and of course it makes the life harder in that sense, that when you stick to that principle, and I think it is a very valid principle, it gets somewhat harder. But like for us, and I think for our investment strategy, and of course for other early stage firms like ourselves, I think that principle or approach is still very valid one. And I think we've seen those companies now, also coming from Finland, also coming from our portfolio, that you can achieve fund returners even that fund sizes are getting somewhat larger.
No, that's very true. And as I mentioned previously, your track record is pretty amazing. And if we look at the kind of Finnish VC scene, I would think that majority of the funds are deploying to a certain extent similar strategy. And as you said, it's pretty regular talking about this looking for fund returners.
I would think so, and it really comes down, and I mean, we've been in this business for 15 years, and there are, of course, funds outside Finland who've been in early stage investing early stage for some tens of years, and you start to see this, like familiar concept, the power law, that there are always these outlier companies in funds that really create the returns. And that's, we both know you need to have them in order to have a well-performing fund.
Absolutely. And then, well, you've been following Gorilla's journey for years, as this is a small market where we are, and now that I've been there, we've been having a lot of discussions about Gorilla and our strategy as well. And I think even though the starting point with us is exactly the same as you, that we are usually the first institutional money in the companies, the investment strategy and philosophy that we've taken is quite different from the regular VCs. So if, as you mentioned, majority are looking at each investment as a potential fund returner, at Gorilla we are looking at it completely differently. So when we're looking at the exit market in the Nordics and in Europe in general, for years it's been plus minus 15 million euros.
Yes.
The average or the median exit for companies, and therefore we're starting not from what's the best possible outcome, but from what's the most likely outcome. And in the early stage, this 15 million exit seems to be the most likely outcome if there is a good outcome.
Yeah. But that has served you well.
Yeah, it has.
Seen your numbers as well. So
yeah, no, absolutely true. And I think the point that I would be making here, and that I think is valuable for the audience as well, is that you can have kind of similar funds in the same market operating with very different strategy and still both performing at a high level, but because of the fact that this 15 million exit is what we start with as the most likely scenario, then our fund is looking at companies that are very capital efficient, because if you need to make a happy ending for the founders and the investors alike at a 15 million euro exit, then you can't raise too much capital in order to be able to achieve that success.
Yeah, that's a very smart approach. And I think it's also something that's, I think, gradually, or maybe not even gradually, but coming back to larger VC firms, and not only talking about us, but like many bigger firms, that capital efficiency is again something people focus on after the years that, we've all seen capital was cheap, or at least it was available, and the businesses you were backing and supporting were, I would say, doable and able to be built in that kind of environment. And now times being quite different.
Yeah, I would agree with that, and I also think essentially that oftentimes when we look at kind of the way media is reacting and the public reactions, we oftentimes celebrate the large funding rounds, but we should also understand that whenever you raise a large funding round, you're raising the bar for your exit and what you need to accomplish in order to be successful. So it's not all fun and games. There's a big liability that you're taking on
No,
as
it's
well.
true.
And
It's
that's, I
true.
guess,
It's true. And of course,
yeah, yeah.
for like something to founders to keep in mind, like goes without saying, but capital you raise, even that you're able to execute it at higher and increasing valuations, you always have the dilution. So that's of course always the question that kind of if you can build in a capital efficient way with less capital, with less dilution, the bigger share you have of the company whenever it is exited.
Very true. Very true. One of the things that I also want to touch upon, I mentioned that in our end, the capital efficiency is one of the 8 criteria that we have, and it's a critical component of that. You also talked about this understanding the customer need, and for us it's very critical, because when you're looking at the types of businesses that we're investing in and where you want to be successful with fairly little capital, then you need to be really focused on what you do, and we often talk about this question of why are the customers buying? What makes them buy, and gaining that understanding, I think oftentimes for a lot of early stage companies is the most difficult question. Building their technology, being passionate about what they are doing, that comes naturally, but really understanding not just is this fun to have, is this nice to have, or is this really something that the customers must have? But I think one of the distinctions that I see in that space, even though both of us are paying a lot of attention to that, is that when you're looking for those fund returners that really need to grow to be big companies, oftentimes they're not just tackling the problems that the customers have today, but they're looking for new ways of changing the market or rewriting the market. So from that point of view, what types of characteristics, what is it that you're looking from the team members to have that type of a vision, to understand that it's not just what the customers want today, but it's what the customers want tomorrow?
Yeah, it's a good point, and actually, like, you're raising a very good topic, which I forgot to mention in the beginning, that the kind of, when we talked about market being one of the investment criteria for us, like that you're able to build, you operate in a market where you're able to build a substantial business. Quite often the key criteria is really the size of the market, but more like that with your hypothesis, what you're going to build, actually it will lead to kind of expanded market. That market that you see today actually could become substantially larger. Maybe something like Volt is a good example, that starts with like rather straightforward concept of delivering food from restaurants, but then becomes, I don't remember exactly how they define, but like kind of Amazon almost type of everything store in that sense. And if you look at already what services you're able to get through Volt, it's a good example that you create something that constantly, once your product develops and you're able to keep the loyal customers, meaning they're happy with your offering, the market keeps expanding and creates, at least, and I think that's the kind of minimum requirement for that you're operating in markets where like valuable companies can be built. So that's, I guess, what we try to analyze and see. But it's more, I would say, really, again, it sounds a little bit conceptual, but the way the founding team has approached it, that like, what is the first urgent market need they've identified, and then we quite often, I believe, talk about this kind of, that is your solution like 10x better, more efficient, easier to use, more like simple solution and so forth. So you try to see how did they come with this idea of starting business, solving this problem. And I think it's a lot of grinding in terms of tens of customer interview or potential customer interviews and gathering information from different sources. But of course also the team composition, that is there already like domain expertise that like is technical expertise so strong that actually they're able to kind of imagine where the market could be heading and so forth. So again, I don't know if there's a specific answer, but it's really the way they approach that.
Very true, and I think, as said, it's that there's this added level of complexity that you need to have people who can see what the market could be when they are kind of not finished, but further along in their story. Whereas I think in our end, when you're typically looking at slightly smaller exit market, where oftentimes if you are solving an actual problem for a customer today, there's always going to be someone who's going to be interested in acquiring you and using your solution as part of their broader service. When down the line. So in that sense, I think our focus is very much looking at, okay, well, what's the problem that you've identified for today, and how are you looking at solving it? And then we don't need to pay that much attention looking into, okay, well, how is this going to change and shape the market, and what's going to be that.
And sometimes also maybe just like again that like both of us invest in different type of companies, that sometimes there is this, like you could say, more maybe longer term customer need, in that sense that you need to build something that just takes time first. I think we work together with a couple of companies that it's not even easy, or I don't know, even possible to verify the customer need in the very beginning in a very concrete way, because you first need to have your like pretty demanding technical solution first, and that may take a couple of years even, and you need to be able to fund the company during that period. And that's of course, I don't know how much you're into hardware type of investments, but that's also quite a big part of what we invest in, that companies that just to get to the first customer stage can take a couple of years or more, and can even cost like not millions, but maybe even some tens of millions.
Yes, and because of that kind of upfront needed investment, those types of investments usually don't end up in our portfolio, because it's not within our capital efficiency criteria. But as you did mention, it's very, very typical that you have those types of cases, and then as we know that almost none of the companies end up exactly in the business that they thought they would when they started the business. So you have the morphs along the way, and the more capital heavy you are in the beginning, the more money it takes for you also to morph and so forth. So it starts compounding. But
no, it's true, and that's of course like kind of goes without saying, but one of the characteristics of really strong teams, that they are able to navigate in a world which kind of keep changing, and their own plans keep changing, or like there will be delays, or they cost more, or sometimes I mean we've all seen also the situations where they start doing something, and after X years or X months they go for another path. And again, that happens, and I would say even with some of the best teams, we've seen that what they ended up building was very different versus what we invested in.
Yes, and I think there are a couple of characteristics that really are required from the founders in that sense. So the first one is this adaptability, that you are able to hear what you're being told. You're not too stuck on your own way of thinking,
Exactly.
because otherwise you're going to miss those opportunities. And then secondly, it's the resilience that you need whenever you figure out and find out that, okay, now we do need to change direction, and this is once again going to take a little bit longer than we thought that it would. And after all of this, so it does take a special type of a human being to be able to go through that grind.
And then to do that, I mean, exactly right. And then to do that as a team, that what you think you were starting with your co-founders, and then after learning many things, you end up doing maybe something different, or at least in a different way that is your, how to put it, founding team still aligned. And that's, I guess, maybe one of the lessons learned is that when you evaluate the team, that's the hard part, that to see that the founder relations in a different type of situation, or when things have not gone as they should and so forth. So actually, I still think that most of the teams would have been able to do the kind of what they wanted to build, or they kind of building blocks were right, but then the kind of founder relations kind of did not work out at the end of the day. That's of course something where an investor should play a role to see that happening, and to trying to kind of build again the alignment. But again, I think to founders, that's something you should discuss upfront if you can. I guess the conclusion is that founder relations and that kind of, they matter more than you think.
Absolutely. Now, trying to sum up a little bit all of the things that we've discussed, if you try to put all of that into a little bit of advice, so founders coming in looking for investment from Lifeline Ventures, what would be your kind of summarized guideline of what to keep in mind when raising money from you?
From us?
Yeah.
I think we discuss all this, but it starts with the team, that proving that you are really the team who's able to do this, whatever it is that you are, that you understand the kind of potential customer problem, or you've already even validated it in such a way that investor can, how to put it, follow your logic and see the work that has already gone into that. And then we maybe didn't mention it, but we to think that the initial team, be it then founders and maybe some early employees have already joined, that they should be able to deliver the first product. That what we don't like is that you come with your founding team and say that if we get money, then we are able to hire these people, and only then we're able to do. Of course, you're going to need people along the road, that goes without saying, but we think that the initial team really should be able to do it, deliver the first product, which is probably not a great product, might even not be, how to put it, or borderline functioning, but still, you should be able to do that with your initial team. So that we would like to see. And then, of course, that we together, it's of course more at this stage our job to evaluate, but you should, as a founding team, be able to give some guidance on this fund returner type of approach, that, okay, what might be the sales price, or what might be the market size in terms of consumers or B2B customers and so forth. So you should have some kind of evaluation that this company could become quite big. But of course, it's important also then to somehow to be aware of, I'm not saying to come up with perfect competitor analysis, but you should be able to kind of convince not only investors but customers mainly that why you are the team who's able to deliver something that has not been possible today. So it's always good to understand, of course, that you have a how to put it, humble approach, but of course confident approach that you are the team, but you understand that there are many others who are probably building something quite similar. So, I mean, all this, and then of course, I mean, this now becomes a long wish list of things we would like to see, but yeah, of course, you would like then to see the kind of clarity in all this, that like way you describe your team, market opportunity need, customer need, how you get those first customer, how your competition, and then maybe also, of course, certain view on that. Like, of course, you have an idea that how much money you want to raise, but I would say also the rationale that why that's the amount you're raising and so forth. So a lot of requirements, but on the other hand, then reality is that, I mean, most of this is, I would say, tackled in discussions with founders. So we don't expect like, extensive materials and so forth. So which, I mean, I don't know how your decision making works, but that's probably another topic for discussion that like, okay, how do you then make the decision whether to invest or not?
Yeah. No, I think it's great to hear your list, and one of the, once again, if we look at founders and the types of investors they are looking for, I think that kind of that focus on having initial view on how you can be a fund returner is essentially guiding and forcing the teams to look kind of 5-10 years down the line. What does the story look like when you get there, and especially in these more capital heavy investments where, as you said, it might take 2 to 3 years to even have a minimum viable product that you can start then matching against the market needs. So they're kind of the way we're looking at the world is vastly different, because if we're looking at capital efficient companies that are solving today's problems, then we see almost no value looking 5-6 years down the line, because nobody knows. What we want to know is what's going to happen within the 12 to 18 months. What are you going to do, and then when do you envision that you're going to be cash flow positive?
Yes.
Because once you hit that cash flow positive stage, then for the first time you're responsible for your own destiny. You can raise more money if you want to, but you don't have to, and you can build the business in a more flexible way. And in the environment of today where the markets go up and down, it might be that you hit this critical path when you need to do your fundraising and the market is completely down. So if you're already cash flow positive at that stage, then you can hibernate for a while and then raise when the market gets better again. So,
I agree.
So therefore, I think, and you were asking how do we make the decisions, and that's a good point. We get a lot of good deal flow, and we're very happy with the amount that's coming our way. And when we do our initial screening and when we look at the companies, we're not even evaluating, do we think this is going to be a good company or a bad company? What we're evaluating is, does this company match our investment criteria? Because even if it's a great company but doesn't match our investment criteria, doesn't matter, because we have promised our LPs certain types of investments, certain type of companies, and we're very strict in that investment criteria. And because of that, 80% of incoming cases to us we can rule out in a very short amount of time, just by the fact that, okay, well, this doesn't really match our criteria. And then for those that do match, then you need to dig deeper, as you said, and then having the discussions with the team, digging deeper into the way they are looking at the business is very critical. And I think one of the things that I've learned along the way, and I think it's very similar to any managers looking at investments, is that what's on the deck, what the numbers are, doesn't matter. What really matters is when you ask what are the assumptions that they have used to come up with those numbers, the quality of those assumptions is going to be the one that you base your decisions on. That have they really thought this through? Do they have that, as you said, domain expertise and understanding? How does this market work? And how can they justify any of the figures that they put in there?
No, I fully agree. And I mean, that's also the like, in an ideal world, you have that domain expertise and, but also that like, and I think that is a super strong like building block, but also many parts of that can also be kind of acquired and learned. And it is, as you said, it's what goes into those assumptions and what the process has been. How have you validated and how you have also how do you understand also that there are things that you don't know, but you're going to kind of find out. So, and that I think is very much the kind of discussion and spending time with those teams where you have made the decision that, okay, let's dig deeper.
All right. There are a lot of things we could still discuss today, and as you mentioned, diving deeper into the decision making and how we look at things is something that really would be worth digging into, and I think would be good for our audience. I think we'll have to continue this discussion at some other point. I think we've covered as much as we can today. So I just like to get into some closing questions that we do on each episode, and because for us we really emphasize the curiosity and learning. We want our founders to learn something new every day, and we challenge ourselves with that as well. The first question that we have for each of our guests is that what do you know today that you wish you had known years ago?
Good question. I think it probably, I mean, if I do reflect a little bit this discussion, it's that the team evaluation, I think they're probably a bit difficult to say exactly that these are the things that I wish I would know, but I think after being investor for quite some time, even in startups, you start to see and experience situations where you see that, okay, actually those things could have been identified in the beginning. So I think our thinking and my thinking is that like you should be even, how to put it, go one or two levels deeper in that team evaluation, but also in that sense that to form a view in the beginning that what can you do, and whoever is involved in the company outside the founding team, that how can they support the team, that you should probably start with a like certain kind of team evaluation also, that how do they as individuals, how do they work together, and what are the things you may encounter with this kind of personality type and so forth. So I would say even more focused approach on team evaluation. That's, I guess, what I would know. And then, of course, that sometimes it would be good to understand that these are super long term. I mean, you're always a little bit of an optimist, although you think that there's going to be a like long journey, but it almost is always is even a longer one, and many other things will then come just from that. So I guess in somehow, I don't know if you can learn that, but maybe to think different outcomes, that actually instead of 5 years, this is probably like 10 years and will cost more in terms of money that you need to raise more and so forth. So I mean, not a perfect answer, but I guess it does that like
those are So really the crucial impact of the team and understanding how the team not just performs the task, but how they interact with each other,
exactly,
and
how you could help them in that, and exactly,
and then this kind of understanding that oftentimes, if not always, takes longer. And even though you don't want to,
no, exactly,
you don't want to kind of give into it, but still you need to learn to live with it. That's what
and
happens.
that will have very practical implications. That you may need to raise an additional round, and you may need to do many other things, and you should be able to support team in that sense. That also that, like, I mean, we're still following the path, but it just takes a little bit longer. So I guess the investor's role there should be a little bit the kind of that, okay, I mean, don't worry, we'll get over it type of approach. And maybe that's, but I don't know if you can really learn that.
No. But those are the learnings you've seen along the way. That's what happens.
Exactly.
All right. So then the second question is that what could have helped you to move faster on your learning curve? And of course, now this question is related to if you look at yourself as an investor along the years. You've learned and you've seen a lot of things, but
it's a good question. I think it's really not blaming my background because it's been like, how to put it, I think helpful in many ways. I've been working also with buyouts and like mature businesses where we always had the measures were maybe different, but the approach was the same, that you want to grow those, you want to invest in like good or great companies, you want to get growth, so you're very growth focused, and you want to improve and make them better long-standing companies. And I think to some extent those are exactly the same things we do with startups. The only difference is that quite often you start from like the stage where there is nothing, but that's the outcome. But maybe that takes a little bit, and for me has taken a little bit time, to learn that in those companies there's of course a lot of stability, and they're just like slightly different in their risk profile and so forth. So maybe being an entrepreneur at some point could have given you that kind of perspective. But luckily, I think we as a firm, we have a good balance of people who've started businesses, been founders many times, and then more people who've been like, I would say, more in the role of investing in those private companies.
All right. Well, thank you very much for joining me today.
Thanks for having me.
I look forward to continuing this discussion a little bit later on.
Likewise. All right. Thanks, Sami.